Good morning, everyone. Sorry for the delay here this morning. We're going to go ahead and get started in just a minute. We do want to make sure that everyone knows that you all are muted, but if you have any questions, feel free to reach out in the chat and we'll try to get those answered. And then we do want to remind you that every Tuesday we have our webinars at 9 a.m. You can find all of our webinars on our website at yaim.com/training. And with that, I will hand it over to Derek. Take it away, Derek.
Thank you, Jordan. Hey, everyone. This is Derek with American Independent Marketing. So to start with, we'll kind of run through some of the upcoming webinars. As you can see, we got one coming up on the 29th. So go ahead and make sure you make it to that one. All right, as far as what we're going to be talking about today, it's going to be long-term care, standalone policies, traditional, whatever you want to call them, right? Same product, but kind of making it a little bit more competitive for today's market and just, closing more sales, getting more interest from your clients, and kind of how to go about that. So to go through this process, basically, we're going to start and kind of take a look at, the different trends, market, what's been going on, not only this year, but in the recent past. There's going to be a little bit of a skew thanks to 2021 with the Washington Cares Fund Act. And then we'll move into how to approach those conversations, kind of how to get that interest from the client, in order to help better serve them, take care of them, offer the solutions that are going to really get that more buy-in from the client, as well as transitioning into how can you actually build these to make sure they're competitive, to make sure people are going to get them. All right, so starting with what's been going on in the market, I'm sure all of you guys are pretty aware that we're really not in that golden age of long-term care anymore where they're just policies are flying off the shelves, everyone's getting them, right? When you look at what's been added as far as new lives over the years, 2020 had just under 50,000 new lives added. This is going to be from the Milliman survey, so pretty good, pretty accurate, covers a large percentage of what's going on in the market. Moving into 2021, it jumped up to 150,000. Now, a big part of this is obviously, like I mentioned, the Washington Cares Fund Act. Washington itself accounted for the majority of policies sold that year, and it's kind of a one-off. Now, having said that, this is something that may come into play, again in the near future with some different states discussing doing what happened here in Washington in their own state, like California, New York, just to name a couple of the bigger ones. So there is the possibility that this may happen again. So kind of keep your, touch on what's going on in your states and see if that's something that might be coming down the pipeline, and make sure you're in a place to take advantage of it if it does happen. Moving into 2022, those numbers dropped to just over 27,000 new lives added, right? So a little bit more than half of what it was in 2020. And then the trend kind of continues to go down into 2023 with just under 25,000 new lives added. So the market's getting smaller and smaller as far as new lives added. We've all seen this, right? And as far as something else that was a little bit interesting, kind of in the trends to watch, policies that are bought at the work site have drastically been dropping as well. So of course there's a huge peak in 2021. Once again, most of the stuff from that year you can just throw out the window. It's very heavily skewed because of what happened here in Washington. But as you can see in 2020, it was about 21% of new policies, new lives, whatever you want to call it, added of the sales were occurring through work sites, right? When you fast forward into 2022, it drops to 8%. Into 2023, it was all the way down to 5.4%. So there's a bit of a trend of worksite not being as popular as it used to be. When you go back before 2020, it was very heavily in the 20, 30% of, new policies being added through worksite insurance. So something to kind of keep track of. A lot of individualization has been happening as far as policies and, what the trend is showing. As far as the most common policies being sold, right, over the last, few years, mainly moving into the last year, what you've seen is the most common benefit period is 4 years. Okay, it's about 54% of all policies sold are around 4 years as far as the max benefit for what they're getting. The most common age ranges are going to be between 55 and 64. That accounts for almost 50%. Now, within that, the breakdown is 55 to 59 is 23.1%. 60 to 64 is 25.7%. One thing to note with this is that age range for both of those, the 55 to 59 and then 60 to 64, has been dropping steadily over the last few years, by a percent here or there each year. Whereas the age group of 50 to 54, which only accounted for 14.4% of sales, has been growing by a few percent each year. So with that shift, a lot of people are going a bit younger for their customer base, client base, what they're looking for, what's getting through. Part of that has to do with underwriting. Obviously, if they're younger, they're hopefully healthier. It's easier to get it through. Part of that has to do with premium. Once again, younger is cheaper, right? But you're seeing this shift. Um, it's more of a gradual shift. It's probably not going to change overnight unless the carriers do something. The most common age range is still what we've all been working in, that 55 to 64. But it is starting to trend towards younger ages. So that's something to keep note of as you're moving forward with this. As far as the most common benefit amounts, the largest percentage is going to be in that 3,000 to 6,000 a month amount, and then it goes into that 6,000 to just under 7,500, right? Once again, with the trend, that 3,000 to 5,900 amount is slowly dropping each year percentage wise, while the 6,000 to just under 7,500 is slowly increasing. Obviously, with the cost of critical care increasing, more people who are buying these policies who actually want to make sure they have enough to cover what's going on are getting bigger amounts for the benefits. So common sense to an extent, but it's just part of the trends of what's going on. More people are buying bigger benefit amounts, obviously. Um, Having said that, the 3,000 to 6,000 benefit amount is still very popular. A lot of people are getting this to cover at least partial costs of moving forward to kind of make sure they're a little bit insulated and not having to get everything out of savings. And then last thing on the list, right, premium is a huge objection a lot of people get when it comes to traditional long-term care or standalone policies. Uh, so for each individual insured, it's around $3,500, right? A little less. That's what most people are spending for their annualized premium, right around there. So this is going to give you a decent idea when you get into making some of these builds of what's actually selling, right? Now, this doesn't mean that you're not going to sell something with a much higher premium, that you're not going to have something with lower. Once again, this is just the average, but it's kind of showing you out of all those policies that are being sold, this is what the most common stuff is. So it's something to keep in the back of your mind as kind of a starting point when you're moving forward. All right. So one thing that is interesting to note is, as we mentioned, long-term care for standalone, new lives added is dropping year after year. With that, only 3 to 5% of Americans 50 and older are paying for long-term care policies, right? So a very small percentage of the seniors or people over 50 that out there that really need critical care, because most people over the age of 65, the majority of them are going to need some kind of critical care services before they die, right? 70%. Pretty good odds that they're going to need something. With that, there's about 120 million US citizens alone, right? Age 50 plus. There's over 4 million turning 65 each year. And that kind of sweet spot as far as premium, getting benefits that make sense, is going to be from 50 to 65 years old, right? So it's encompassing that huge percentage of age ranges we saw that make up the majority of what's actually being sold. So they're in line with each other. The only thing that doesn't really line up is there is still a huge, huge client base out there that really needs something to take care of this issue with critical care costs later on that isn't getting it, right? Some of this is being done through some different options and some different routes, but it's something that needs to kind of be brought to the attention of the clients of, hey, you're going to need this, right? The odds are saying that you are going to need this one day. So it's something to keep in mind. Obviously, yes, sales are dwindling when it comes to standalone, but the clients are still out there. There's still a huge opportunity to go out there and be able to close sales, right? But with that, you got to make sure you're doing it the right way. So one thing I do want to touch on is there's a lot of different options out there, right? For this presentation, webinar, whatever you want to call it, we're going to be looking more into the standalone traditional long-term care. But obviously, when you're meeting with your clients, don't get fixated on just standalones or just hybrids, right? Try and find the right way to meet their needs and offer a solution that's going to best fit that. So there's a lot of different approaches out there. But one thing that's nice with this is that when it really comes to taking care of critical, you know, coverage down the road, critical needs that these people are going to get, there's really not much out there that's going to be better dollar for dollar at tackling critical care, right? Long-term care, traditional policies are designed with that specifically in mind, whereas hybrids are kind of dual purpose. So they have some great points. They fall short in some areas. When it comes to short-term care, obviously, you know, short-term benefits, right? So if their main concern is critical care, there's really not going to be anything out there that's going to be better than a traditional policy. All right, so let's get into how you're going to approach this conversation with your client, right? Most of you guys are pros at this. You got it down. With me, it always starts with kind of the same usual questions, pretty much regardless of what type of policy I'm selling. Obviously, it varies a little bit, but why are they looking into long-term care, right? And you can plug and play any kind of policy there, but what is it they are thinking about? What is it they think they need to get from this? Why are they looking into it? Let them answer that, right? Take down some notes. From there, what apprehensions do they have about it? Okay. Most of the time, when it comes to long-term care, it's going to be, you know, the premium, right? That's going to be a big apprehension. It's going to be that premiums might increase down the road, right? So it's not really locked in. Another one is going to be that use it or lose it, right? If I don't use this, what happens? So finding out kind of what's holding them up about it is going to make it easier to address those issues and sell the policy. Another one I really like to get right off the bat, because it just makes building something competitive a lot easier, is what is their budget, right? What are they hoping to spend on this? What can they afford? Sometimes those two things are different. So if you can get both of those, you know, what they want to spend and what they can actually afford, helps. Especially because sometimes you can offer them a lot more competitive policy, something that's going to be a much better solution to the things that they are worried about, right? So that's why we're asking them, what are you looking to get out of this? Another reason for that first question is simple. If their main concern is critical care, then we're probably going to start by looking into traditional or standalone policies. If they're wanting to leave something behind and they're worried about this or that, then we'll start looking into hybrids, right? It helps kind of direct what's going on. It's much easier to get the client and kind of lead them gently with different questions to the solution than to just propose it, okay? And then lastly, one thing that I really like to get is what is their health? And obviously you need their age and a bunch more information, but are they healthy, right? Because if they're not, Standalone long-term care probably isn't going to be the best option. It has a lot more stringent underwriting, as I'm sure you are all aware. So it's something that you kind of want to get out of the way. If you do not have a pre-qual kind of generalized question sheet, reach out to us. We do have one. It'll save you a lot of time and headaches down the road. So it's something that's really good to get out of the way up front. And then once you get all this, you can really kind of steer that conversation to go with the solution that's probably already popped up in your mind, right? And lead that client to get there. And then when you lead them, like I mentioned, they're coming to that solution in a way by themselves, right? You're kind of just steering the ship, helping them get there, and it's going to make them buy in a lot more to whatever you propose as a solution for them. Right. So now we're going to get into the fun part of this, right? How do we build all this? How do we make this competitive, assuming we have someone who's actually healthy enough to qualify, right? Assuming we have someone whose main concern is, insulating themselves later on if they have to get some kind of critical care. So to start with, I'm going to show a little bit of difference in why the industry is kind of getting down to those lower ages. So as we mentioned, the average individual premium is just around under $3,500 a year. Okay. This is a couple. So the monthly total here is just under 5,000. Both the male and female annually are individually under that average amount, which is kind of nice. This monthly benefit's $5,000, so it's kind of in that middle, you know, above average range as far as when you take what's being sold between 3,000 and 7,000 for the monthly benefit. It has a 3% inflation for lifetime, right? So with that, we're at $4,900, give or take some change, right? For the couple, each, annually what they're paying. So part of the reason the industry is shifting a little bit is at age 50, that's what they're paying, right? If we keep everything, basically the same, the premium goes up, right? And one thing we did change on this, just so we can show some of the differences here, is we increased the inflation a little bit. So inflation itself on these is going to have a huge impact on the premium. So one thing we can't change is the client's age, right? They come to us at whatever age they come to us. We can advise them that getting it a little bit younger is going to save them some money, which it will. But we're limited in what we can do on that. Versus when it comes to inflation, we have a lot of flexibility to be able to influence the premium and what's going to come from that. And this is really important to note because a lot of people who've been selling standalone long-term care for a long time are very set on the fact that there has to be lifetime inflation or maybe 20-year inflation to try and get the client to at least 75 years old before that inflation stops, right? They're very set on it has to be 3 to 5%, okay? You can do that. It is going to make the policy a lot more expensive. And in some cases, it is going to be a very drastic increase simply by having larger amounts of inflation on there or longer terms of inflation on there. So that's something that I'm kind of, really pushing right now because I'm going to illustrate that in a little bit. But it can have a huge impact on that premium and making these policies much more attractive as far as what they're getting, for their dollar, what they're paying into it. Okay. So a good example of that is we got a 60-year-old couple. They're both pretty close to the individual kind of average for what they're paying annually. The female's a tiny bit over, but as we all know, females are a little bit more expensive when it comes to long-term care. The male's quite a bit under, right? So what we're getting here, still $5,000 a month, for the benefit. It's going to last about 3 years. We have a 3% lifetime inflation on this, and their premium is, $6,300. If we simply just change the inflation leave it at 3%, put it at 20 years, it drops down to 5,100, right? So that's over $1,000 annually just by going from lifetime inflation to 20 years inflation. One thing I like to look at when I'm building these is, like I mentioned, trying to get your client to at least age 70, preferably 75 or 80 for the benefit amounts. Part of the reason I say that is because we saw that most of the people who are, out there in the US are going to need some kind of critical care, right? And a pretty good percentage amount once they're 65 or older, right? So when you're talking about almost 3/4 of the population needing to get this critical care, it's a good thing to make sure the money's there around that age when they're going to need it. So 65, 70, 75 at kind of the latest, right? Making sure that their benefit is going to be big enough to actually take care of those needs somewhere in that age range. Some people will point out, well, lifetime is going to keep growing, which is correct, but is having, $7,500 at age, and this isn't accurate, but just for illustration, at age 70 and paying $1,000 a year less more of a benefit to the client than having $9,000 monthly by the time they hit 90, right? When they're probably going to need that care before then. So it's something to kind of keep in mind as far as making these a bit more affordable and actually more applicable to what's going on in the world, right? These people are probably going to need care at age 65 or 70, right? Doesn't really matter how much money they have in there by age 90 because they're probably going to use it before that for most people, right? But as you can see, definitely has a big impact on what's going on in the premium. If you guys aren't as familiar with this version of the quote tool for custom solutions, it is something that we, built with Mutual. It's something that we do offer. So definitely give us a call, ask when we call on our follow-up calls to you guys, and we can walk you through getting this and then using it. It is, the main tool we use for quotes here in the office just because it is so much more simplistic and quick and really easy and great to use. All right. So as I was kind of touching on earlier, right, we got two different, breakdowns here. Okay. So what we're really looking at on this left side is we have a premium of about $5,100. Okay. So it's still going to be for 3 years, $5,000 a month, and it's going to have a 3% compound with inflation for 20 years. This is something I always love to look at. So when you jump in here and you kind of go to that middle column on the left of monthly benefit, 3%, 20 years, it breaks it down really nice. So this is going to max out in year 20, right? Because that's when it's going to stop growing at $9,000 a month. So when we have this client, right, who is 60 years old, at age 80, they're going to max out at $9,000 a month. Like we talked about, there's a pretty good chance they're probably going to need those benefits before then. Okay. Another way that's really becoming a lot more popular is front loading those benefits, giving them a bigger amount right off the bat with no inflation. So as an example, I went a little bit crazy on the right side. I did a benefit of $10,000 a month for 3 years. So double what we're starting out with on this other one. The premium for the couple is $600 more a year. Okay, so obviously we could have done this at 9,000 and got that premium down, whatever the case is, 8,000. But I just really wanted to kind of show you how this works, right? So I exaggerated a little bit on the benefits. Okay, so even with the inflation on the left, the policy benefit amount will never get as high, even if the person's 90 years old, than we're starting out with on the right. But the premium's about the same, which is kind of nice because you're also eliminating the risk of what if this person needs this at age 65, right? Instead of collecting, $5,000 a month, they're going to be able to get 10,000, you know, right away, 5 years from now. So that's going to be a huge kind of selling point of look, you're going to be getting a lot more money here. Not only that, but it's already at 10,000 all the way through. So whenever you need this, you're at $10,000. You don't have to wait till age 80 to get up to $9,000, right? And this is a big thing to kind of get through not only your client's head, but a lot of agents' heads that are still stuck in we have to have inflation, right? We have to have this in there. You don't really, right? Because even with inflation, it's still not going to grow as big as just front loading it. And like I mentioned, we could have put this at 8,500, 9,000, which would have dropped that premium pretty much to around what you're getting on the left side of 5,100, right? Like I said, we went a little bit higher than we needed to just to illustrate the point. So front loading has become very, very popular, not only because of the premium, but also because it helps take care of the client, right? They have more money to be able to use sooner rather than later. And as we saw, when it comes to averages, most people are going to need this once they hit 65, right? Or a little bit older. So it's good to make sure they have that money there, they have that money available, right? You're really kind of doing what's best for the client, not only for their pocketbook, right? But to make sure you're helping insulate the cost of what's coming down the road. Right. Another thing to point out is while there isn't as much variation in premiums year to year, like when it comes to a product like MedSup, where it's kind of a revolving wheel of who's going to be the cheapest, I highly recommend shopping around a little bit with NGL, with Mutual, with Thrivent, right, the big companies, and seeing who's going to be the best fit for that client for quite a few reasons. So one thing that's really kind of important is pricing. So when it comes to certain things, as we kind of see here, we got no inflation. We got about $5,400 a month on the far left side. We're looking at an annual premium just under $2,000. Okay. The thing here is some of these policies are going to be cheaper versus carrier to carrier based off of age, what's going on just by itself. But also some of these policies offer some cool things depending on what their budget is. And I'm not talking about just all the different riders and shared care and this and that. Okay. So one thing I like about NGL, depending on where you're at and what's going on as far as states and everything else, is they do have a return to premium option, right? They got some different options as far as it comes. Some give a little bit more back, but it helps kind of alleviate that use it or lose it objection we were talking about earlier, which is why a lot of agents end up going to the hybrid, right? Because they're not going to lose it if they don't use it. It's going to go somewhere. This will do, to an extent, the same thing, right? Depending on which option you select. So, like I mentioned, 5,400 a month, no inflation. We were talking just under a couple grand annually. When we jump over here, we're talking just under $3,000 annually. So it is a bit of a step up. But when you have certain clients whose main objections are going to be, well, what happens to this, right? Where's it go if I don't use it? That's probably going to be worthwhile to them. And also, there's a lot of different things you can adjust to kind of get that premium down. So it's not going to be set in stone every time you do this. It's going to jump up, by $1,000. Okay. So that's a really good option that NGL offers. And then another thing that's kind of great with them is if you do have a younger client, right? Right here, we're talking about people who are 50 years old. Okay. Doing something like a 10 pay is going to help alleviate that objection of, well, what if the rates increase? Because it is a well known fact, and we have all seen it, and everybody's seen it, that those older long term care policies that people were buying for, not too much premium back in the day have increased over the years. So that's something that's been stuck in a lot of people's minds. Whether that affected them directly or not, right? So this is a way to, take someone who's 50 and then at age 60, they're going to be done paying, right? Good chance those rates are going to stay where they were because they're only having to pay them for 10 years and then they're done, right? And the nice thing is it's going to have some cost savings versus paying this over the lifetime of the policy. Obviously, it's going to jump the premium up quite a bit over those 10 years. So in this case, they're paying a little over 5,000 every year versus, that 2 or 3. But they're going to be done. The prices are locked in. So this just gives you some different tools in your tool belt. Once you find out what their main objections, what their main worries are going to be able to show some different options and really where it's going to work, right? Return of premium options really good for people who do have that money, right? Same with 10 pay, who can afford a little bit more. Maybe it's more than they were hoping to pay, but if it addresses their objections, they're probably going to take it, right? So not getting locked into a carrier, into a product is going to be a really good thing for moving forward. Making sure that you have some different tools, some different solutions to be able to offer your clients. So wrapping all this up, right? This is pretty quick. We weren't going to jump into all the fun, riders and different things out there. There will be times when you do have people, such as a couple that's looking for the best shared care. Not all shared cares are created equally amongst, standalone policies, right? And that's something we can get into. Give us a call or when we reach out, ask us. But there's some different one-offs here and there, right? I like to kind of take every client as a case by case and find the best solution for them. But this is kind of more of, okay, how can we take this policy that people are saying is too expensive, right? That people can't get through underwriting, people are worried about using it or losing it, right? Those big main objections and addressing those to be able to put the client at ease, right? To get them to buy in to what the solution is. And it's pretty simple, right? I mean, a lot of the stuff has changed to front loading versus, doing a lot of inflation. Um, there are times where inflation is still good, especially if they're younger, like 50 years old, and they do hopefully have 15, 20 years before they're going to have to use it, right? But if they're already older to start with, front loading is going to be the way to go, not only because they can use it sooner and have a bigger amount, but it's going to help with their premium, right? Giving different options of 10 pays is going to be important, or single pays if they can afford it, right? Return of premium options is going to be a big one for some people. So just using these different kind of methods, and then like I mentioned, obviously prequel, right? Have that generalized health questionnaire that's going to knock out a lot of the big stuff. Um, and it might be a little bit of a letdown when they come back and you're like, okay, you're not going to qualify. Okay, well from there, go ahead and pivot to something else, right? Go ahead and look at short-term care. Go ahead and look at other options. Maybe they really want life insurance and they don't have it. So you're going to start looking at hybrids, right? Not getting locked in. But if their main concern, their main reason they're doing this is simply to get critical care down the road, there really isn't much else out there that is going to be able to touch what a standalone policy can do. Because, like we talked about, that is what it is made for, right? To address that one concern. And that is why it is so good at it. And there's ways around the premiums and all the things that are making agents have a hard time selling it. And we can get a lot more into depth, kind of one-on-one, because there are some good questions that are a little bit more specific, right? But there's a lot of different things that can be built to adjust to the needs of the client, right? It's not just a cookie cutter. It's not everyone's going to get the same policy. There's many different things that you can play with in here, okay? So that's kind of long-term care, right? There isn't some super complex loophole that you have to try and jump through to be able to sell it, right? While the industry, obviously the trend is decreasing, there is still a huge percentage of potential clients out there that really need this because they're going to have those costs down the road, right? the majority of people are going to need some kind of critical care. And being able to, adjust a few things, whether it's inflation or whatever the case is going to be huge because it's one of those things that's going to take them off the fence, right? So don't be scared to have these conversations just because of all the stuff we're seeing in different magazines or out in the news where, standalone long-term care policies are dead. The new wave is hybrids, right? I love hybrids. They're awesome, but they're not always the best answer. Okay. So just really take a look at what's going on, get familiar with those different quoting tools in there and how simple adjustments on some of the different, options in there can really, really change a premium, right? Sometimes simply going from lifetime inflation at 5% to a 15 or 10 year or even 20 at 3% can almost drop the premium in half, right? Simple little things like that where people are so used to, well, this is how I did it 10 years ago, right? Those little tweaks can have a huge difference. With that, I want to say thank you to everybody for being here. I will be reaching out to address some of those questions individually just to see if anybody has any questions. If there's anything you guys are curious about, please give us a call in the office, shoot me an email. We're always here to help. And then, like always, make sure you jump on for our next webinars. There's always some great tidbits you can take away that are really going to help you better serve your clients, make more sales, right? Get familiar with the industry, what's going on. And I hope everybody has a great day. Thank you so much.